Hey traders, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today's Tuesday, July 30, 2024. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. What do we have on the docket today? Well, the big picture is they made another attempt or pseudo attempt at the lows from the other day last week and the trend line. That's item number one. Item number two is this was day one of a two-day FOMC Kabuki Theater meeting culminating in the FOMC interest rate announcement tomorrow, Wednesday afternoon, and then Jerry's presser. We're getting the pickup in volatility that we discussed. This was the title of last night's video. This was the thumbnail, so to speak. So what do we do with all this information? How do we determine whether there's a forward-looking bull case or a forward-looking bear case? What's the story? Well, the same thing applies that we've been discussing. This trend line is a line in the sand, as is the low from the 25th. Below that low comes into play 533.07. We discussed why that is. That is the most recent breakout area. Now, the only thing you have above that is a retest of the trend line and a gap that was not filled over here, 536.95. The low here was 537.45. So by 50 cents, they did not fill the gap. Just information to know. Know your numbers, know where they're at. They could give you one of those spike the lows and rip it back up in the other direction. Where would they do that? Maybe just around underneath / the gap. New low, spike the trend line, fill the gap. They could rip it back up. I like 533.07. Sticky note time. What about the flip side situation? Let's say the market likes what it hears tomorrow on the FOMC interest rate announcement. The Fed says they're going to cut interest rates at least 2 times this year. Let's just say that's the case. We don't know what they're going to say, but that's the expectation. That's what market participants, media participants, talking head participants, that's what they're looking for. Anything less could be a rug pull situation. The flip side situation, the market likes what it has to hear. What's going on? Well, they're rallying back to this breakdown candle high, 549 and change. Getting above, closing daily above that price begins to open the door to fill the gap a few bucks higher, about 30 or so S&P handles higher. That's the bottom line on the bull case until further notice. Remember what we discussed a few times already. I was looking for a cycle low situation or high, but cycle low in particular that the market's been trading down. A cycle turning point, if you will, is due this week. Funny how that works, culminating with the Fed. We got a trend line breakout type situation, revisit the breakout area. Just interesting how it's all unfolding. 3 weeks down in a row, still have yet to hit the 20-week moving average. Could that happen in this move? Sure it can. It's right smack in the middle of those 3 prices that we talked about last week. And then, of course, we go over to the monthly chart, which concludes tomorrow. The 31st of July will conclude the monthly candle, and it looks like they're putting in a sign and or signal of a trend change / tail candle. Interesting information. Do we have an on-time type of situation? Traders that have taken the course, Lazy E-mini trader, realize that we are, in fact, in an on-time type of situation. Not only from here, but also, in fact, from here. Funny how that works, isn't it? So when you look at this daily chart, for example, and you look at all the weekly and monthly charts as well, you could say, all right, so I could see how the market could bounce up to this 20-period moving average. Sounds like, feels like, in real time, would look like pretty good rally from where we are now, maybe even slightly higher. And what that would really look like when you zoom out to a monthly chart, what would that look like? It would look like a retrace of a tail candle. You see how this all comes together? Light bulbs going on. Bounce off the trend line, first time, best time from a weekly chart perspective. They bounce up, they do a retrace, and then it's make it or break it time. You see how this all comes together? We use all the charts to get the pieces to the puzzle put together. At least I do. What's going on inside the numbers? Let's look at some highlighted stuff. I'll point out a few important things. What I urge you to do is pause the video, read the notes, and go back to the chart to double check the work. Today is day one of a 2-day kabuki boondoggle. What is a boondoggle? It is a project that is considered a waste of time and money and is often extended or continued due to extraneous policy or political motivations. Doesn't that smell like the Fed? Boondoggle. Standard issue is a morning rush hour or so. We got the or so today. 547.05 is our pivot. Let's start there. Pretty incredible. Right of the vertical is today's activity. You see the blue line is at 547.05. Just a little bit above that by pennies. Was in fact the high of day. They got it right out of the gate this morning. Ran a test of the pivot. Our first trade of the day, morning trade, is generally speaking a reaction from the pivot. Some traders got it, some traders didn't. It was a little bit early. I personally was looking for a higher price to short and certainly scared away some traders in the live room. So I take full and complete responsibility for that. In fact, this morning around the pivot was the dead high. Above on candle closes, we don't have to worry about that. But the flip side situation is below the pivot, the door is open to the flat line and lower. 544.15 is important, for example. Now, they did use that as a way station. You see, they did bounce there. They gave traders a quick scalp there. But after a few 5-minute candles, they decided to just head lower. From 544.15 to 544.87, that is our minimum required base hit for traders in the live room. Inside the numbers, we're looking for a minimum required base hit of 5 S&P handles, 50 SPY cents. I say 5 to 7 handles is our base hit. Base hits put us in the Hall of Fame. When they give us doubles, triples, Whopper Juniors, all that stuff, that's gravy. It's icing on the cake. It's a base hit business. We talk about this every single morning in real time. That's why we try and take an exit with a portion of the position and hold a trailer. If we're not able to hold a trailer because price stops us out because they're coming back down, that's okay. We still have a base hit in our pocket with an opportunity for another trade opportunity lower. Let's see what we have as the day starts to get underway. Now look what was said early on. Focus on below 544 on candle closes. Begins to open the door for the leg down toward 541.35. Look at that. Now think about that for a minute. Below 544.15, look what happened. Pretty quick vacuum all the way down there, and then you have a bounce back. That's a trade, albeit it's another base hit, but it's a trade. Pretty funny how that works. Before the markets open for business. Pause the video. Read the notes, go back to the chart, and double check the work. There's other numbers in here. There's way stations in here. There's short-term support resistance in here. I want to highlight a few important things. Those that are interested will pause the video, read the notes, and go back to the chart to double check the work. Just fast forwarding to 12 o'clock, 539.15 is a number that can bounce the tape, is the next zone which can bounce the tape. And there you have it, 539.15. Spiked it by a few pennies, ripped it back up in the other direction, but 539.15 can bounce the tape. Pause them, read them, double check the work. If you're active in the S&P, whether it be options, exchange traded products, futures, micros, it doesn't make any difference. If you're active with the S&P during the trading day, this is information that can help you. Let's leave it at that. So what's going on over in the IWM camp today? Remember 224.60? What's the high of day today? 224.46, not that far away. They're eating time off the clock near the highs. That's the big picture. They're above all the moving averages. The trend is your friend. That's, again, part of the big picture. We know one thing. Whichever way the major market goes tomorrow, the S&P, if it's in a big way, meaning following the Fed, if it's up or down in a big way, I'm not talking about 10 or 20 points in the S&P. If it's up or down in a big way, then the IWM is going to follow suit. It all becomes the same market. Everything goes together. Everything's rallying, or they pull a rug out from everything. So the IWM would have a leg down or a breakout to the upside. This is eating time off the clock after a pullback near the highs. Take it at face value. Yes, technically you have a tail. Yes, technically if you do not close a week above that tail, it is still an active tail for a leg down. But they are still flirting with the highs. We take it at face value. Tomorrow's a big day. This week's a big week. The market's going to take their cues. Do they get disappointed in something the Fed says, does, or doesn't do? Or do they get excited by something the Fed says, does, or does? We'll find out soon enough. What about the folks down at the transportation department? Here's the weekly chart. Staying on that, you could see they're getting above. They popped their head above the trend line. You look at the daily chart and you see, popped above. It was a round low of day. It's telling us something or it's not telling us something. Right now at face value, it is telling us something, but we have the Fed tomorrow. Everything can change, or is this foretelling of what's to come? Is this the canary in the coal mine saying, hey, look, this is the clue. This is the hint that they're going to break to the upside. And then you look at the other side of the equation. You have the Q people, and they made an official test of the 100-period moving average, spiked the low from last week, which the S&P did not. There's the spiders. They did not spike last week's low. SPX did not spike last week's low. And there's the Qs, did spike last week lows. So the Qs have relative weakness from a chart perspective than the S&P. Write that down, put it on a sticky note. That's an important number for the Q people, at least for the next day or so. Sticky note material. If the Qs rally, for example, and get above today's high, then guess what? They start working on yesterday's high, and then they're working on this breakdown candle high, which is similar or same to the spider one that we talked about early on. Nothing wrong with the financials, at least the XLF. They were in rally mode, up 1%, 50 cents, challenging the highs just made a couple of weeks ago, or less than 2 weeks ago. Tail candle weekly chart, eclipse and close the week above that tail. There is no tail. She's bullish and going higher. Where to? This is a new high situation anyway. You see, at least for the XLF, she's in no man's land. We'll leave it at that for the time being. Above all the moving averages, yes, overextended in air quotes, no measurement for that, but they are above all the moving averages. The trend is your friend, a little bit extended or far from home base, so therefore we know she likes to come back to pay a visit to home base. Doesn't mean it happens on a schedule. It means it's expected that it's going to happen sooner than later. And here's another melting down situation. Smash mouth below last week's low, finished below last week's low. Getting tossed out with the baby and the bathwater situation. Shot behind the woodshed 3 times. Down almost 4% today. $9 plus. Is this a washout? Or is this the canary in the coal mine and the transports are not? If the transports are the fake out and this is the canary, money still running from tech, or has money finished or almost finished running from tech? We don't know yet. It'll be gauged based on the Fed reaction tomorrow. Not what the Fed says, what the market reacts to what the Fed says. And does, by the way. 223.75, write that down, circle it on a sticky note. It's a pretty important spot. Here's a weekly chart. Just logically look at it like this. There's got to be something important in here. Okay, just think about it logically. The market ran up, 1, 2, 3, 4, 5, 6, 7. 7 weeks traded around this line. Okay? It's got to be something important in here. My number's 223.75. Is it 224? Is it 223.82? Is it 222.91? It could be anywhere in there. My number's 223.75. There has to be something important in here because the market ran up to there and stopped. Ate time off the clock for a while. This is a weekly chart. That's a while. Broke down and back up again. Isn't this some kind of breakout area? You betcha. Have I told you how much I appreciate each and every one of you? Without you, these videos are not possible. That is true and accurate information. We're pulling the ripcord here today. I'm David Frost, My Strategic Forecast. Thanks again for tuning in to another episode of Common Sense Market Analysis.